Hello, everyone. Thank you for joining us today for the final session in our post-election webinar series. My name is Mark Heath. I'm partner and director of tax services here at McConley and Asbury. For those of you who joined us for our first two sessions in this series, welcome back as we continue to discuss how the presidential election may impact you and your business for 2021. If you couldn't join us for those presentations, be sure to catch the recordings on our website at macpas.com/webinars. If you're not familiar with McConley and Asbury, we're a team of CPAs and business advisors serving clients from our offices in Camp Hill, Lancaster, and Bloomsburg. We provide a variety of services to industries including the ones you see on your screen. We encourage you to visit our website at macpas.com in case you didn't catch that the first time to learn more, and don't hesitate to get in touch with our service or industry experts to explore how we can partner together to best serve you and your organization. Before I turn things over to our presenters, I want to mention that if you have any questions for them during the webinar, please submit them through the built-in questions function in the webinar control panel, and we will do our best to answer them during or after the webinar. There will also be 3 polling questions throughout today's presentation, so be sure to answer those if you're looking to obtain CPE for attending today. Today, I really can't say just how excited we are to have Rick Lazio and Dean Zerbe of Alliant Group join us. You may recognize these names from both the Washington circles and from past webinars and Collaborate conferences that M&A has had. They've helped us out on a bunch of this stuff in the past, and the insight they have in what really goes on in Washington is fascinating. So we're hoping to get some updates today, and as we all know, the Congress is meeting right now trying to hammer out a deal, and Rick and Dean, we are relying on you to give us this super secret scoop here so we know what's going to happen. So thank you everyone for joining us. I'm going to turn it over to Rick and Dean.
Thanks so much, Mark. Greatly appreciated. Thrilled to be here with Conley and Asbury and talking to all the good folks in Central PA. We've had a long-time relationship with your firm, Alliant, kind of working in the back office, you will, with your clients and helping them get back millions of dollars in tax savings. So it's been a great partnership for both of us, and really, most importantly, for all your good clients that you've been working with over the years. And so we're pleased to have everybody here. I think it's so important that people are talking to Conley and Asbury about what's happening in taxes, what's on the future for taxes, and sharpening your pencils on taking best advantage of it. So we're going to, let me just get us here. There we go on the slides. There's a little bit of us, I think, for those not familiar with the Alliant Group, kind of some background for us of what we do in our work, and some of our board members there, a couple of former members, commissioners of the IRS, as well as a number of folks with experience on the Hill as well, too. So we've got a broad range of folks. It's a 900-person shop overall, though, in terms of it, and have offices nationwide. Joining me is the fabulous Rick Lazio, a former member of Congress for years, and is just still extremely well versed and up to the minute on what's going on Congress and what folks are thinking about. He has just got very good close personal connections with them. But I would say to you too, just kind of a clear-eyed savviness about what's possible or doable in terms of the Congress. So that's Rick for you there. And then that's me. And you can see my background there, Senior Counsel, Tax Counsel for the Senate Finance Committee for a number of years, and involved with a lot of the kind of the day-to-day technicals of getting the tax bills through and what have you. So I think we give you a pretty good coverage of what's possible and doable out there and what's going on. So Rick,
it's just very rare. I want to note that it's very rare to be described as both fabulous and a former member of Congress. So maybe
you're really the only one, Rick. If there was a Venn diagram of what would be a fabulous member and yeah, you would be it. So I commend you for that. That's right. Exactly. Well, let me turn it over to you, Rick, to kind of start us off about the elections and setting the stage. And then just for folks listening, what we're going to do is Rick's going to set that stage. We'll talk a little bit about the COVID bills and what's happening right now, but then spend the rest of the time talking about really the first year of the new president, what's possible, and kind of through both paths of, okay, if the Democrats have a good night in Georgia with the Republicans, we'll take you through both scenarios. But Rick, go ahead and give folks your outlook on the elections.
Thanks so much, Dean. I just wanted to do a couple things. First, also from a housekeeping standpoint, also to say I very much enjoyed working closely with McConnelly and Asbury. They're a terrific firm, and as you will note during the course of this conversation, there are a number of very significant, very important tax changes that are underway, and never has it been more important for you to spend some time with your CPA at McConnelly and Asbury to understand the right strategy as these changes affect your business and you and your family individually. I also wanted to note, we sort of whizzed through that description of people that are on our advisory board. And of course, the first person up was former Pennsylvania Governor Tom Ridge, who I just spoke with this week. He was doing well, and he knew we were going to present and wanted me to send his regards to all the folks in the greater McConnelly-Asbury family. So there we have it. So, hey Dean, so we had a big election. You'd have to be living under a rock not to know what the outcome was. Of course, the president had, in many ways, a good night, an unexpectedly good night, in that he received 74 million votes. That was the good news. 74 million votes, more votes than any incumbent president had ever received. The bad news was that Joe Biden got 81 million votes, 7 million votes more than the president did. And as most people know, the Electoral College vote took place earlier this week on Monday, and Joe Biden is now the president-elect. In the House and Senate, also expected to be areas where Democrats thought they had a shot at taking control from Republicans. They had some very close races, and Democrats did pick up a couple of seats, but as of now, Republicans have 50 to Democrats 40. There are two races that are still outstanding, and these are the two key races that will determine who controls the Senate, and they'll be determined during the special or runoff election in Georgia on January 5th. And those polling numbers, Dean, are very close. I've seen some polls that have the Republican candidates, Loeffler, the incumbent, and Perdue, the incumbent, up by as little as 1. Some that have them up as much as 3. But in no poll that I've seen are they down much beyond that 1 up or ahead by more than 3. So this will be a race about turnout. Republicans had a few seats they were deeply worried about, and the incumbents were behind in the polls, and particularly in Maine, North Carolina, Iowa, and Montana. And in those 4 key races, Republicans did prevail. This was not a good night, election night, for pollsters. There was some, material differences in the ultimate outcome relative to what pollsters predicted, and that will be a subject of discussion for many months to come. And so the House races, also Republicans outperformed there relative to projections. Most prognosticators believe the Democrats were going to enlarge their majority. They had a 232 to 197 seat majority in the House going into the election. And it looks like when all is said and done, and believe it or not, there's still some races that are not yet called and may not be called until January, including one in my frozen home state here of New York. It looks like Republicans will be within single digits of being able to recapture the House in 2022. And of course, that's generally a time in midterm elections for a party who holds the presidency that is not good. In 2018, Democrats picked up 40 seats. Back when I ran and served in Congress, Republicans picked up 54 seats in the midterm of President Clinton. President Obama lost 60 or 70 seats during his midterm. So generally, these are not good times for the incumbent, but we'll see how it plays out. Right now, Democrats will control the House, Republicans the Senate. Obviously, President-elect Biden will be in the White House. And one last thing I want to mention, Dean, is that in the state races, which many people neglect, they are important because they will determine through reapportionment how some of these districts look and therefore what the outcomes may likely be, and that's important. In this case, Democrats have targeted a number of state houses and key seats to win in order to be in a stronger position for reapportionment. They fell short in all of those. Republicans actually picked up both state houses and seats at the state and local level. The one exception was, again, my home state of New York, where Democrats have a supermajority, what's called a supermajority or veto-proof majority now in the lower and upper houses. So that's the way the election played out.
Yeah, very, very interesting in terms of the what's today's. Let me go back there. The realities on that, yeah, and I think particularly the House being tight is kind of a new journey, and being, when you've got only 5 votes you can give up. We'll talk about that more. That's a different world entirely from what folks are used to. Usually you've got 15, 20 seats that you can kind of play with, and if Jimmy's out with a cold or Mary just doesn't feel like voting your way, not a big deal. Now, they're gonna really have to do close head counts, I think, on okay, who's here showing up to vote, and then if we got everybody in line, it seems it's going to be a much different journey than they've had in the past. So
this will be a real test of leadership, Dean. It is as you point out, it's a much more difficult job. And on the Senate side, regardless of who ends up in the majority, they're both the leaders on both sides. Chuck Schumer, Senator Schumer on the Democratic side, and Senator Mitch McConnell on the Republican side are going to have their work cut out for them in terms of just all they need is one or 2 people taking a walk or feeling like they want to join the other side, or they may have different geographic or political orientation. It's going to be empowering to moderates, and you will see that there will be some pretty hard feelings, I would imagine, between people within the parties, as you'll see some of these divisions and some members using their leverage in a close majority to be able to extract some good outcomes for themselves and for their states.
Good points, and we'll of course see all that in taxes. So let's talk as advertised about lame duck and what's going to happen here. Rick and I were actually exchanging thoughts on this just before we got on the air, because it's such a moving world right now. And so what you've got is the COVID bill, and it seems that's finally shaping up now. Rick, one thing I for sure want to make certain we put on there, because I know it's of huge interest for the accountants listening, but also for all the businesses. They've made it clear that they're going to have the deductibility of the PPP expenses where the loan's been forgiven to be deductible. That seems absolutely crystal clear from my reading. Is that what you're hearing too, Rick?
Yes, that will be in this package that's moving, yes.
Yeah. So that's a big kind of number one item. And then talk to us about PPP in general, Rick, what they're going to do. It seems it's going to be another run, but I know you follow this closely.
Yeah, so the package that's been agreed to, which was originally scoped out really by a bipartisan group, and that could be a model for things to come interesting to watch. But it was hammered out. Last discussions with Secretary Mnuchin, Treasury Secretary Mnuchin, and Republican and Democratic leaders just happened yesterday. And the package looks like it's going to be about $748 billion, with another $150 billion or so for individual or direct checks that look like they will be about half of what they were the first time they were sent out. So more like $600 than $1,200, which is what people received originally. The remainder of the package will be a combination of things: unemployment insurance extended likely for 16 weeks, with again about a bit of a haircut in terms of the what the federal enhancement will be, probably like $300 a week enhancement, money for vaccine distribution, schools, $25 billion for rental assistance, and then of course there will be some relief along PPP. There'll be some amount of money in there to extend PPP for a period of time. We'll see how quickly there's uptake on that money. There are a number of businesses, especially if you look at some of the service businesses, restaurants, and others that are really barely keeping on by their fingernails. There's some relief in sight for them. What was left out of this package, famously, was the two priorities of the individual parties. On the Republican side, liability protections for businesses as a result of COVID exposure, and the state and local aid the Democrats have been advocating for. They couldn't agree to terms on that, and so that was set aside, and that will be a subject of something that will be focused on next year.
Right, next year, right. I must admit, just as a personal note, I find it kind of almost head scratching that they couldn't come to an agreement on that, but maybe there's an aspect I don't understand of this issue on the immunity from suit. Anyways, I don't want to get into it, but I was surprised that seemed to be what I thought was a fairly straightforward ask. But right, and then on taxes, this is where it's a bit upsy downsy. There's two provisions early on that Rick was particularly good at focusing on. One's the employment retention credit. And we talk about this now a little bit because even if it doesn't end up in this end of year package, which we expect will be both COVID relief plus spending bill, and then maybe there's going to be a tax package added to it. If it isn't, look for it in kind of a February, March timeframe. So this employment retention credit, something that's gotten pretty bipartisan, bicameral support, is a version of what we had seen earlier in the year in one of the earlier COVID relief bills. But kind of on steroids, 2.0, if you will. It's a bigger dollar amount that it covers. It covers more businesses in terms of who can benefit from it. It's quite robust. So I think keep an eye out for it. If it's in the bill, you're going to want to definitely be talking to your folks here and your good accountants about whether it's something to look at. And for the accountants listening, you're going to want to be thinking about whether this is something for your clients to take advantage of. So that's a pretty big piece and has gotten some attention, but maybe it'll be in the package. I think it's Rick and I kind of keep going between being Eeyore and Tigger about whether we're feeling upbeat or not upbeat about whether these tax provisions are going to be in there. And then this health and safety credit's another interesting one where, Rick, I always kind of butcher explaining it, but basically if you're in a business, I think both the service industry, but really think of it as a manufacturer too, that you're having to do changes in your work and how you're doing what you're doing to keep employees safe, keep customers safe. You can look for a credit for that. And that, again, is a pretty robust tax benefit. It's bipartisan support, but it's more, they've kind of set themselves on a dollar figure, and that's kind of kept how many folks they can put in the lifeboat. And these are both pretty costly items. And then the last piece on this is the extenders in general, the tax extenders. Always, we've got a number of tax provisions that are running out. Energy provisions, 179 Cap D, very important for architects and engineers that do work with the government in terms of energy savings. Anyways, kind of a host of 30, 40 provisions that are out there. The thought is, the last I had heard, Rick, is, well, maybe it'll get attached. There's a 1 year extension in this kind of wrap-up bill. And I just don't know. I mean, it could happen. It doesn't have to happen. They could look at doing it next year. There's kind of a natural, I would say, push, though, particularly there's always two schools of thought, it seems to me, Rick, with the new administration. One is, why do a deal now? Because, we'll get a better deal once these rascals are out. On the other hand, there's a thought that why are we going to take all the oxygen in the room and waste all of our time with all this kind of housekeeping stuff when we've got, great things we're going to accomplish in the first 100 days. I think they're leaning a bit more towards the idea of having a tax package on there, but I don't know if I bet 50 cents on it. It's just kind of so up in the air. But Rick, anything on what I've said, give us your 2 cents on how you see the outlook on all this.
Well, taking the last point, Dean, the spending authorization runs out at midnight on Friday night. So that's what's called a must-pass bill. There's every expectation that this will be passed on a bipartisan fashion. There is a good chance, I would even say a probability, that the COVID relief package would be joined with the spending authorization bill and will be taken up sometime tomorrow, if not later on tonight, and passed, by the Senate and by the House. So I feel pretty good about that. The extenders bill, the tax extenders bill, is something we would love to see done right now. I would say if it doesn't get done on this vehicle, I would not think it gets done this year. It won't get done by the end of the year because they will basically be out of session after this, won't be back, and I doubt that they would do this by something called unanimous consent. But that's possible, but I think unlikely. More likely, if it doesn't get on this locomotive that's leaving town, it would be taken up sometime early next year, and in all likelihood made retroactive. It's a bit of an annoyance and a frustration, especially for the CPAs on this call, to have to figure on, advise clients when there's uncertainty. So I have sympathy for that, but I think there's general strong bipartisan support for an extender package. There's things that folks on both sides like, and there's nothing in it that they really hate. So it's relatively innocuous, politically innocuous bill, and not as costly as what we're going to be talking about a little bit later. I just want to mention a couple of things, if I can, Dean, on this employee retention credit. Many people on this webinar may be thinking about the original version, where the maximum was 50%. The maximum credit to the employer was 50% of the first $10,000, so $5,000 credit. What they have been talking about is something materially more robust than that. Anywhere from something in the $20,000 range to something that could be as much as twice that much, $40,000. So this would be something to really watch if it's included in a package right after the end of the year. That health and safety credit you had right, Dean. This is, if you're an employer, you're spending money on PPE, on erecting barriers to keep employees safe. If you're adjusting your production to enhance the safety of your workers, any of those types of things, you would be eligible, the employer would be eligible for a credit, a federal credit, to help soften the blow of those costs. And those two things, the employer retention credit and the health and safety credit, are both broadly supported by the House and the Senate and by Republicans and Democrats. You say, okay, well, why weren't they in the package? Because it just added cost and it opened up the tax chapter to add-ons that nobody wanted to deal with. So I think these two will likely be in another version that will happen sometime in the early part of next year.
Right. And one last thing, just we'll go on to a polling question here in a second, and kind of leave this kind of lame duck piece of the pie, is just to emphasize again, though, because I know it's a huge question. And again, if you've got any questions, put them in the chat box. We're happy to take them. But again, when we, just to be clear, the provision regarding the deductibility of the PPP loan expenses is separate from these other tax discussions. Members are extraordinarily understanding of how important this is, and that's baked in the cake already. So I don't want you to come away thinking, okay, well, that's a tax provision, so I guess that might not go. That's kind of its own little world, and that is in the package. So separate from these other tax provisions we are talking about. So just to be clear there. So here's our first polling question. I'll let our good folks take this.
Thank you, Dean. So polling question out there for everybody looking for CPE. What piece of COVID legislation is most important to you/your business? PPP deductibility, an extension or round 2 of PPP, state and local funding, or something else? So, Rick, you touched on something there that I think I speak for all accountants, that the past year, the only thing that's been certain has been uncertainty. So it's been real fun trying to project clients' tax liabilities for the end of the upcoming year here. And but one thing I wanted to inquire about, so the employee retention credit, right now you can't take it if you took a PPP loan. Is there any talk of removing that so that you can do both?
Well, you can't take it if you get the forgiveness piece. So you can't. What they would view, what the IRS would view as double dip. Not clear in a package next year if they would I think, Mark, it will depend in part on how we're doing in terms of employment and economic growth. I believe that we will see. I know there's a lot of economic forecasters who are predicting a strong year next year. I don't doubt that will be the case toward the end of the year. I'm not so sure that we will see such strong growth in the early part of next year. And if I'm right and that's the case, I think that adds more pressure to ensure that there is more aid for small businesses particularly. And that would mean to me that they would revisit this possibility of being able to get the retention credit even if you have applied for and received forgiveness on a PPP loan.
Interesting.
I think you're right on that, Rick. I get the sense that was kind of when they put out the first run and really didn't know quite what they were doing and what have you. I don't get the sense that they're really as tossing and turning and worrying about that kind of play as much. So I think we'll definitely want to look at the legislation when it comes out, but I've not seen that. And also, they're, again, kind of betwixt and between. On the one hand, I think they're looking at making it easier to get forgiveness for the 150K or lower. But on the other hand, there, as you probably well know, Mark, kind of fuss and feathered about some of the abuses. So they're looking at a hard eye at or encouraging the executive branch to take a harder eye at various fraud. But just to be clear, what Washington is worried about is not, these kind of very gray areas of, well, my business was okay or not okay. They're worried about the headlines they're seeing of, prisoner Joey getting a loan. He doesn't have a business. I mean, kind of really just flat out fraud is something that they're, I think, going to want to see some attention to. So yeah, we'll see how it all comes out here, but definitely worth looking at.
Interesting. Thank you. So no surprise here as to the results of our first polling question. PPP deductibility is the main driver in all of this. That's what everybody's looking for. And it is very encouraging to hear both of you say how important this is. And hopefully, even if they don't get a COVID relief bill passed here, that they'll consider this separately or part of another tax package to make sure it gets done. Back to you. Yeah,
guys. They'll do it. It's going to be in there. They're going to get a COVID relief bill, and they're going to get and they're going to have this in it. I mean, I never can say 100%. Oops, today's. I'm sorry. Let me get to. What do I do here? Okay, there we go. All right, now, yeah. So yeah, I feel pretty. Rick can see if he's got a different take, but life's never a guarantee until it's signed and on the desk, but. They clearly seem focused on getting over the line. They're going to stay in through the weekend, and this certainly will be a provision in it. I mean, that's my outlook. I don't know if you have a different take, Rick.
No, I have little worry about the fact that this is going to get done.
Yeah, so I agree with that. So we talked about the elections, and I just want to remind everybody listening, because folks, you've got your businesses to deal with, and you got 1,000 things running through your world, and I get that. And Rick and I wake up every day having to worry about the Congress and what they're doing. And what I'm leading up to is folks can actually think, well, I know there's a filibuster rule. What's it really even matter if it's a 50-50 Senate? They'll still be able to filibuster. And I've been told that they're not going to change the filibuster rules. Yeah, fear, as they would say. They say, fear not, yeah, fear, because what you can do in the Senate is through a reconciliation process, you can move legislation with only 50 votes for the 50-50 Senate. And of course, with the vice president, you get the tiebreaker. I'm not going to kind of bore you all with the joyous rules of reconciliation, but suffice they are there. They're basically a procedure where once per year, I guess, rather, Congress can move legislation that has an impact on spending has an impact on entitlements, has an impact on taxes within a 10-year window, you can move legislation through. It's difficult. We did it all the time, though, under Bush W. If you can remember the 2001, 2003, 2005, all those were reconciliation bills that we moved through, including in a 50-50 Senate, the original George W. Bush tax cuts. So it is a vehicle to do things. That said, it is the devil too. When you've got 50 votes in the Senate, and this takes us back to it, every senator's a kingmaker, or a queen. They can decide what they like or don't like. So it greatly narrows what's possible. And then on top of that, this is kind of what brings us back, Rick, to things you and I are talking about, is that it isn't like normally when we did these, it was all about the Senate, and it actually drove the House to distraction, because we would just come back and say, well, here's the deal we've agreed to, so you're going to just have to take it, because we've gotten all the senators we need on board, and we can't kind of change it, and the House would just be absolutely beside themselves that they couldn't kind of get their pull on the oars. But
I remember.
Yeah, yeah, that's very annoyingly, yeah. So there is this means to do it. So I don't want you to be sanguine, but it isn't that easy for them to do either. So, but I do want you to be realizing filibuster does not bar them. Filibuster on other things, like, say, be it immigration law or other things that are not spending it. And just as a quick nut, so reconciliation, you've got to have it be provisions that impact scoring. It's a 10-year window unless it's revenue neutral. Obamacare was passed through reconciliation too, even though they had plenty of votes. They used it again because it's an easier vehicle to move that kind of legislation. You're reconciled to a dollar number. It's a net number. This is where scoring matters so much as well too. So I just do that all as a preface for you to think about it. So now what I wanted to do, Rick, I didn't know if there was anything, Rick, you want to add about the joys of reconciliation or anything else before we start getting into the actual provisions.
Well, just to add a fine point here. So if Democrats pick up both of the Georgia Senate seats on January 5th, Kamala Harris as vice president will be able to break a tie. They'd have 50-50. They'd be able to break a tie. And they would have the potential to use reconciliation to pass whatever tax reform they can get through with their 50+1 margin in the Senate. So what we're going to be talking about, these scenarios, is a very real scenario.
Yeah. So that's why Georgia's on everyone's mind. So let's talk first about the corporate rate, and we're going to go through a lot of the major provisions here now. And if there's one that you want to make sure we cover, put it in the chat box, and we'll definitely cover it. But we're going to go through quite a number of the big boys here. So corporate rate, this is something that Biden really campaigned on. Looked at raising it from 21 to 28%, which is still lower than where it was historically before the Trump tax reform. And I apologize, one other thing to bear in mind. You're going to hear us kind of going through all these tax increases, and there are some tax cuts that the Democrats are putting forward too. But remember, the Democrats have spending proposals that they want to do of increasing spending on X, Y, Z. And again, Rick and I aren't here to, yay or nay any of that, but just to bear it in mind, it isn't like a Democratic senator would be faced with a vote of, okay, well, how big of a stick do you want to thump these guys with? It'll be, well, Senator, we're going to be raising taxes on the corporations, but geez, we're going to spend that for a tax cut for working families, or we're going to spend it, use it for this spending proposal. You get the idea, folks. So just kind of bear that in mind, that it's not just who could vote for that, or how would anyone go for that? It is part of a bigger package, and that gets, members, it changes the calculation for them. So 21 to 28%. Rick, when I look at this, I think the Democrats campaign clearly on this, and I think that matters. I mean, you'll hear us talking about it, that when it's kind of something that's more in the weeds, that there isn't this kind of clear mandate, I get a little bit nervous. But you and I had the fortune of being on with two of our other board members, former Senator Heitkamp, who almost was nominated to be the Secretary of Agriculture for Biden, and Congressman Joe Crowley, who just really knows so well what's going on the Democratic side. They seem to have a lot of confidence that even with the tight Senate, that assuming the Democrats get control, that they would get the 28% passed. How do you see that?
I think that's probable also. I think I put this on a high probability list on the list of tax changes that President-elect Biden wants to see. Now, we could end up with, keeping in mind that there are 3 or 4 people, Mark Kelly, newly elected in Arizona, Senator Joe Manchin in West Virginia, Angus King in Maine. So maybe a John Tester. Some of these people could use their leverage in a 50-50 outcome in the Senate and say, I'm not going to go along with it unless it comes down to 26 or 25 or something like that. So I would say somewhere between 26 and 28 is where they land now, Dean. I think they pass this.
Right. Okay, fair point. Let me get it. There we go. This is the one I really wanted our good folks, McConnell and Asbury. I know they're familiar with it. I think a lot of you listening are very familiar with it too. This is the Section 199A deduction. So just to remind you, this was kind of put in place in the tax reform bill by President Trump and the Republicans to make sure that small businesses pass-throughs would benefit. So it, quick thumbnail, it helps small businesses in particular, regardless of what they do, but then provides a particularly significant benefit for folks who make things, manufacture things, architects, engineers, broadly speaking. It was designed so that they couldn't be on the javelin receiving team of saying, oh, you've cut taxes for those rascally bankers and lawyers. So it also has the kind of the reality, though, that it makes it a little bit tougher rhetorically to get rid of it as well, too. That it isn't just, oh, yeah, well, we're going to, fix their wagons type of deal. So it's a pretty robust benefit that's out there. And the Democrats have said, as you can see here, kind of $400,000 or higher in income. This is a very big ticket item. In other words, they raise a lot of money out of this, just as they raise a huge amount of money from the corporate rate as well, too. So these are big ways to get the money they need for other spending or for other taxes that they want to deal with on there. I'm going to let you go first on this one, Rick. As the little lady would say, how do I know what to think until I've heard what I've said? I want to get your take on it before I say anything of what you think the chances are on it.
Well, I just wrote a op-ed with one of the CEOs that we work with, Myron Moser, that got published in Newsweek, where we're talking about manufacturers and how some of these changes would be detrimental to having the sector grow given all the headwinds. So this is one area here where advocating for a hike on small business who are organized as pass-through entities is a bit discordant with the overall theme of trying to help small businesses that are hanging on by their fingernails, trying to survive, especially in the next quarter or two. So I put this as lower odds than the C Corp marginal rate change. I would say this is one of those areas where a small band of more moderate Democrats could stop this in its tracks, or alternatively increase the fees out for income in excess of, say, $1 million. But $400,000 for most parts of the country, if you're a manufacturer or you're in some technology or in any of these many areas, is not that much. And of course, that means higher taxes for the pass-through entities, means less money for workers, less money for new machinery, less money for just to keep the doors open. So again, I'd say lower odds of having this one passed.
I think that's a fair point. I agree with you, and it's something that, to be honest, you didn't have Biden, kind of thumping the table saying, by God, next year, Jerusalem, we're going to get rid of Section 199A. I would say candidly to folks listening, this is where you all will matter. I mean, and again, just to be clear, if the Republicans have a good night in Georgia, none of this is kind of happening. I mean, they're not going to go along. They're not going to go along with any pullback on the tax cuts that were in the tax reform bill that they just passed. I mean, that's a general concept. And we'll talk about areas that we think they could find agreement with in a Republican-controlled Senate, but C Corp they're definitely not going to do. This is another example of something they're not going to do. But going to Rick's point, I think members do not, know this issue as well as they know other issues. And you've got, Senator Toomey obviously would be supportive of keeping it in place, but I would encourage you, for Senator Casey from Pennsylvania, moderate Democrat, I would want to be educating him mightily about, if you care about this and if your company cares about it, making him aware of this impact, I think could have a real change in what happens. Like I said, it all comes down to one vote. I think you're right, Rick. It could be that, well, all right, we'll do it at $1 million, or we may delay, who knows what they'll do. And we'll talk about that aspect of it as well, too, of the overall economy. But I just mention that as well for folks listening, that if you do care, educating members will matter a lot. And obviously your House members as well, too, given the tight Congress. Rick, this is an area that is kind of part of some general real estate development provisions that you really focused me on that I hadn't paid as much attention to, starting with this provision on like-kind exchanges. Why don't you take us through this and kind of through the other real estate development provisions as well, too?
Yeah, thanks, Dean. So the 1031 exchanges, for those of you who are real estate investors, has been a very useful tool, both in part because it allows you to diversify or reposition your investments with another type of real estate asset or in a different market without triggering tax consequences. This allows for a deferral on the gain of the sale when you exchange it effectively with another qualified piece of real estate, and you carry over the basis, so you don't really realize the gain and the tax liability until something is sold, but you can continue to transfer it through a 1031 exchange. Biden talked about during the campaign eliminating unproductive tax cuts for high-income real estate investors, and people said, what does that mean? Well, 1031 certainly would be something that would be consistent with that comment, but more importantly, one of his closest tax advisors clarified that publicly and said, yes, 1031 is exactly what we were talking about. We feel like it is abused, and we would get rid of it altogether. Now, Dean, you were around, I think, when they narrowed the scope of 1031
right,
for non-real estate assets. But this would be a pretty dramatic change. It would affect estate planning. It would affect investments in real estate, create lots of new tax liability for people that wanted to reposition their real estate portfolio.
Right, and I think it also hives a group that is like putting your hand in a raccoon sack, quite frankly, which is the farmers. The farmers use this more, as I had to learn working for Senator Grassley. They use it more than you and I would think. It's kind of for them a common thing in terms of their own farming and investment strategies. And then, you've got the depreciation here, Rick, as well, too, is another one within this real estate. And I don't know how much of this was driven by animus against, President Trump and his tax situation drove this, and maybe that the ardor will cool somewhat with him leaving office. But anyways, the depreciation is another part of this that is already set to begin to kind of pull back some over time. But take us through this.
Yeah, in the Tax Cuts and Jobs Act, there were new provisions for expensing and bonus depreciation that allowed for certain qualified assets to be expensed or written off in the first year of service, which was really a boost for businesses that were capital intensive. And it's a great thing for the economy because it incentivizes more purchasing of materials and plants, equipment, and all the people that assemble that. But President-elect Biden during the campaign talked about increasing the depreciable life of rental real estate, which would add cost. This would mean you'd be able to depreciate over a longer period of time, less each year than you would have under current law. And so this together with 1031 exchanges changes in 199, changes in C Corp rate, changes in individual marginal rates. We'll talk about this a little bit later, but it's not that any one provision is going to make a dramatic change in someone's financial outlook, but when you start to pile them all together in the aggregate, it becomes daunting.
I think, why don't we stay on this just for a moment? You're right, usually we kind of come back to this when we talk about the top rates, and just as a preview, President-elect Biden's talked about raising the top rate. That's something, again, I think, just to get to it now, Rick and I both, I'm not putting words in your mouth, Rick, that we would normally say, sure, there's a strong Democratic consensus to raise the top rates, that even the marginal, the moderates would be comfortable with that, blah, blah, blah. But I think that's an excellent point, Rick, particularly with the economy. I saw employment numbers, and you watch them much closer than I do, kind of continuing to kind of list along, and the feeling that the economy's in this holding pattern almost. And again, that's something we raised with our Democratic counterparts on the panel a week ago, and I think they agreed with it, that would play on members' minds of, are we really going to be, it's kind of like loading the mule up. Are we really going to, with a tough economy now, raise, hundreds of billions of dollars of taxes at the same time? And I think you're right. It raises an uncertainty of what they may ultimately be comfortable doing.
I mean, if you're a small business owner, and somebody is proposing phasing out 199, Section 199, increasing the marginal individual rate, so you'd be paying higher tax, you get a smaller deduction, or no deduction from 199, you'd pay higher taxes, potentially treating capital gains, which we'll get to a little bit later, as ordinary income, increasing payroll taxes for upper income people, and eliminating, or going back to the Pease rules, where you had minimized deductions. You take that in the aggregate, and when you see in the abstract, I'm just talking about increasing top marginal rate from 37 to 39.6. That sounds pretty reasonable. If you start to add all these things together, up over 50, then you start thinking, well, that's a pretty potent political attack ad, and I've got to be thinking about whether that really makes sense. So that will play out during the debate, no doubt.
It's kind of an oofta moment, right? So as we've said, though, there are provisions, and this is actually a good discussion of, okay, the Republicans keep the Georgia seats, so then they've got their position. What is the area of doabilities? Well, here's some of the business tax credits that President-elect Biden's put forward: expanding the new market tax credit, WOTC for military spouses, expand the low-income housing tax credit, tax credits for investments in infrastructure. He's talked about domestic manufacturing, and again, that's kind of where a little bit going after 199A is counterintuitive, and that's a tax incentive for domestic manufacturing. But setting all that aside, I mean, I look at this list, to be honest, Rick, and I'm like, sure. I mean, it might get pared back some. I think, again, if the Democrats have a good night in Georgia, they'll look at doing these, and I don't think they'll have any trouble, getting kind of variants of these passed. But even if the Republicans keep it, as they try to find areas of agreement, when I look at this list, do I think it'll be as kind of as robust and as expensive as maybe what the Democrats could do if they're running the show? Probably not. But like we were looking at the green energy provisions, right? And we'll talk about those more later. But I look and say, sure, I think you could find agreements in this area. Any thoughts on that?
I totally agree with you. I think these four areas in particular are ripe for being part of the carrot to bring people to the table, particularly on the Democratic side. Republicans will add some priorities on their side. And that's how these bills get put together. But if some will remember, some of the CPAs on the line will remember that there was a hiccup around the provision, the real estate provision in Tax Cuts and Jobs Act, where there was a drafting error for certain types of improved property. And this affected mostly retailers and restaurants. And Democrats said, listen, you didn't include, we didn't feel included in this. We didn't vote for it. We're not going to be part of changing it, even if it was an error. But ultimately that change was agreed to, and Democrats had a price, and that was an increase in the low-income housing tax credit. And you can see this sort of playing out, this type of thing playing out again in a tight Congress like we have right now, where you'll have a package of some priorities for Democrats, some priorities for Republicans, not a lot of spinach that people don't want to eat. And that could be the outlines.
Yeah, no, I think you're right. You saw, here's our second polling question. You saw kind of some more on the details on the energy side, but Mark, take us through this.
So we just talked about a bunch of potential changes on the business side regarding taxes. So I'm curious for our listeners, which aspect of changes to business taxes do you see affecting you or your company the most? Increase in tax rates, the removal or changes to the 199A deduction, the QBI deduction, the phasing out of bonus depreciation, or something else?
Interesting question. Be curious to see where it is. You know, Rick, while we've got folks here and they're doing this, we should probably mention that another vehicle to move things, just because I know we're coming on time and we want to keep folks on their time, but is the highway bill. We'll have a big highway bill in the fall, and I think a lot of folks are pointing to that as a vehicle, no pun intended, to move some major infrastructure. There's a tax component of that. And so I think that'll be an area, but well, here's the answers. Mark, go ahead, take us through them.
So I'm a little bit, actually a little bit surprised by this. I thought the 199A deduction might come in a little higher. But yeah, clearly everybody's mind is on tax rates, and we're having discussions regularly with our clients because we're in this weird area of, do we actually accelerate income or defer expenses, which is just the reverse of everything you do in the tax world generally, to lock in some permanent benefit with the lower rates that are in place right now.
So Mark, one thing I would say just briefly is taxes will never be as low as they are right now. So they're not going to get better for the most part than maybe for individual taxpayers. But if you look at it, generally speaking, the trend is going to be toward higher taxes. And we'll touch on estate taxes later on. That's also the case, that it will never be a better time. If you're going to kick the bucket, now's the time to do it.
Yeah, I think that's right. And cap gains we'll talk about here. So here's the top rate. We talked about this, again, easy in terms of, yes, if the Republicans have a good night in Georgia, this won't change. If the Democrats have a good night, setting aside the kind of the mule theory of, well, how much can this all bear? I think this is one that they just almost kind of feel they have to do. Given the elections, Rick, if I were the Dems, I'd be like, well, good Lord, we've got to do this, even if it, maybe they would delay the impact or something like that. But I would think that they've got to have a consensus to do this. Otherwise, they're kind of split themselves. But so I'd expect that to move forward. And any thoughts on the top rate there, Rick? I know you kind of talked about it already.
Yeah, no, I think that's what they'll end up on 39.6. Yeah.
This is the one that Rick was talking to, but I wanted to make sure that you all focused on it. So yes, the top rate's the top rate, and we get all that, but where you really get hit, when you heard 50 Cent rap star quoted saying, I don't want to be 20 cent, this is what he was talking about. This is where they're creating a donut hole on Social Security tax. So Social Security tax is many of you know, it's evenly divided, caps out at 137.7, and then that's all she wrote. What they want to do is bring it back, creating this donut hole at 400,000. The 137 is indexed for inflation, so eventually the donut hole would close. But having that at 400,000, so that is, will be put forward as, yes, we want to help solvency. It doesn't do a huge amount for solvency, but it obviously does some help. But it is a very significant increase in taxes that really didn't get that much attention, Rick, I don't think. And I can't really remember what the senator and the congressman, when we were with them, commented about this from the Democratic perspective. But setting that aside, what is your take on a tight Congress, whether, I'm assuming again that the Democrats take Georgia, if they'll get this over the finish line? Your thoughts?
Yeah, Social Security in terms of the benefits have been a third rail. So the parties, President Trump didn't go near it. Neither major party candidate talked about it during the campaign. the trust fund is running out, and this is not really the fix for it. This is simply raising more dollars, and it is a not insignificant marginal tax hike for those people potentially over $400,000. Now, I think that this is not as high a chance of getting done as the individual marginal rate getting done, high bracket rate, 39.6, or the C clip rate, because anything involved with Social Security just tends to get mired in recriminations. But I would say that there is a decent chance that you do see this hike. It might be a bit higher than $400,000. They may end up going back to $1 million, but I'd put it at better than a 1 in 3 chance. Let's put it that way. Of that getting done.
Yeah, and that's a good point. Maybe they take some of the bile out by going higher. Cap gains. This is so. Everyone saw Bob Dylan sold his songbook. And if you didn't
this year, huh? he did some tax planning this year.
Yeah, he did some tax planning. All right. Yeah, the tambourine man has taken one past the tax man. Absolutely. So he did this because I think of the uncertainty that Rick and I are going to talk about. Biden has commented very much, and again, this is something he's clearly campaigned on. So I put it on the high possibility if they take the Georgia seats. They'll go to 39.6. Now, I think, let me go to the next slide here. I guess this kind of lays out the details of it. Over $1 million is where it would kick in. The question that was raised is this going to be retroactive to January 1st of 2021, or would it be date of enactment? And this is where I need to be clear on when I talk about reconciliation. Reconciliation doesn't happen on a dime. Reconciliation moving like warp speed usually will take 6, 7, 8 months. Just so you understand, when we had the Bush tax cuts with EGTRA, it took us till July, and that's where we knew we had to move because we were going to lose control of the Senate because of one senator flipping. And so it could be a while. And the question is, are they going to do retroactive? The thinking is that they probably would do retro at the beginning of the year for ordinary income. I don't know if that's quite a given. But on the cap gains, normally we would say no, they wouldn't. And I think that was kind of the feeling of our Democratic folks. But, clearly Bob Dylan's lawyers didn't think that was going to be the case. And I can't guarantee it because I apologize. I'm going to sound a little sharp, but I don't mean to, that there's two things animating the new folks coming in. Is one is just we want more revenues. You don't raise a huge amount from capital gains. It is a revenue raiser, though. But it's also just kind of an equity thing of, well, we want to, get the rascals. And that kind of speaks towards, well, we're going to, hit them on January 1st. I think they really have to put people on notice that you really have to be signaling now that this is what we intend to do. Because again, it seems to me, Rick, this is where you're right, in a tight Senate, and you kind of went through some of the names, a Manchin, a King, a Tester. I can see them saying, well, fellas, I'm for doing this, but geez, we can't spring this on people, kind of a deal. But all that said is a big windup. I can't guarantee you that if they take the seats, that it's going to go back. And I know it's kind of the end of days here for the end of the year, but if you had something you absolutely positively had to make certain wasn't going to be at the new high rates, you'd want to take care of it this year would be my thoughts on it. I mean, I still think it's an outlier, but Rick, any take or thought on this?
Guys, sorry, I hate to interrupt. We just need to get our last polling question in here before 3 o'clock.
Yeah.
So real quick, everybody out there, last polling question. If you have already accelerated income or deferred expenses, or you're planning on it, again, to lock in those permanent tax savings to hedge against rising income tax rates. If you've done that, we'd love to hear you say yes. I'm curious as to what everybody's doing.
Go ahead, Rick. You were saying about
I see things like you do. Let me just, while we're waiting for these results, maybe for time purposes, we can just talk about estate taxes.
Let's go ahead, Rick. Give me your take on it.
So here's another area that is, potentially dramatic change for estate planning, requiring really a lot of good tax counseling. What President-elect Biden has talked about was, importantly, was eliminating the basis, that the stepped up basis provision which, here you go, here's the results of this.
Mark.
Yeah, we're about 50-50. Just remember, it's not too late. We can, you're not filing tax returns for at least another 3-4 months. So we have time to pull levers if you want to do that.
Go ahead.
Back to.
Yeah, good point, Mark. Thank you for that. You're right. I just want to forward ahead to the estate and gift because you're right. As we get on time, I for sure want to cover this. Finish up, Rick, your thought.
This is a big one. It's a stepped-up basis, which would basically allows heirs to receive assets and get and take as the basis the value of that asset at the time of death. Biden would scrap that, and that would require somebody who is an heir that took an asset that maybe somebody that the decedent, the person who died, bought 50 or 60 years ago for a fraction, to pay tax on the difference between that tiny basis and current value or whenever they sell it. So huge difference, increasing also the rate, the top rate on estates, and also importantly, diminishing or reducing the size of the estate exclusion. So right now, it's about $11+ million exclusion under the Tax Cuts and Jobs Act. President-elect Biden would set that exemption amount to $3.5 million, so you'd start paying taxes after the first $3.5 million, according to the Biden plan. This is another area where a lot of where you have some moderate Democrats and rural state Democrats that have a lot of agricultural constituents, farms. You may see some pushback on this. I particularly think the stepped-up basis is a pretty dramatic change. Going back down to where it was, though, at the $5.5 million level for exclusion, that seems to me quite likely.
Yeah. Well, Rick, I think you've said it well. I agree with you. I think they would do it. Obviously, again, the Republicans take Georgia, nothing happens. It does end in 2025, just as a reminder for everybody, go back to old law. But that's kind of a manana issue. I do think that the Democrats, it's a splitting issue for them. They've got a lot of folks who care about this. I think, maybe trying to do something with the rates to deal with the very big estates, probably they could get some consensus. I think they're going to be very nervous about anything that's viewed as hitting small businesses, family farms, things like that. But we'll see how that plays out. Just real quickly, you can see this list of things that we believe would be possible with the Republicans in their retirement pension, child credit. There's a number of things that would be doable. It'll be a much more limited world, though, and certainly not the tax increases that are being kind of talked about. I think took questions, and if anybody's got any questions here, you can certainly email me. I'll be happy to help you out with it, and also obviously talk to Mark, and he can forward questions to us, and we work with him all the time to help answer them. And we just want to thank you so much for letting us spend this afternoon with you here and our good friends in Pennsylvania, and hope everyone is safe and healthy. And Rick, I'll give it to you for last words before we give it back to Mark.
Yeah, just want to wish everybody a healthy and happy holiday season for a very difficult year. And one last plug, don't forget, as you think about planning, existing tax provisions that may be valuable. One of the areas that we've been working closely with McConnell and Asbury on is to make sure that anybody who is eligible for the research and development tax credit, a very powerful tax credit, especially for small and medium-sized businesses, that they're aware of the opportunity and they're taking advantage of it at a time when everybody's trying to bolster the liquidity. This is an important go-to provision. So I want to thank again McConnell and Asbury for being terrific partners. Encourage the audience to make full use of them this year, and look forward to being there in person sometime next year.
Thanks, Rick. Yeah, the R&D credit, we continue to see tremendous results in industries that we never ever thought we'd have a big R&D opportunity in the past. So encourage everybody to continue to think about that. So On behalf of McConley and Asbury and Alliant Group, thank you for joining us today. A special thank you to Rick and Dean for joining us. It's always fascinating to have your take on everything. Recap of today's presentation will be posted on our website in a few days. For those of you who have requested CPE, those certificates will be sent out within the next week. Thanks again for joining us, and we wish all of you a happy and healthy holiday season and an end to 2020. Thank you.
Cheers all.
Take care.